Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly economic review for the week ending September 6th, 2024. So we had a busy week. We had a Bank of Canada decision, another rate cut in the books, a third consecutive one, and we do think that the course is set for many more cuts coming. There's a race to the neutral rate that is in place right now. We think the Bank of Canada's estimate of the neutral rate is at around 2.75, 3% in this vicinity. So we think that the base case scenario is that the bank continues to cut at every meeting until we reach this level somewhere in the summer of 2025. Also in the US, all eyes were on the labor report that we got this morning as a confirmation looking for confirmation that we would have either 25 or 50 basis points of a cut on September 18 because the Federal Reserve committed to starting to cut in September. There was a speech at Jackson Hole from Mr. Powell saying that the time has come. So the course is set here. We don't think that we will see a 50 basis points cut, although the market is still somewhat leaning in that direction. We do believe that it would be the equivalent of hitting the panic button, and it could have some unintended consequences in risk appetite and risk perception by the market. So likely we think the Fed will not do that, but the report this morning, looking at the details, there's not much here to change your mind if you were thinking 25 or 50. So next week we'll have the CPI in the US. That's the last major data point before the decision on September 18. Maybe that could be a tiebreaker, but nothing exceptional is expected either at this report. So let's see what happens. So look at this week's market. So this week on Thursday. So lower rates. This is the environment we're in. So fixed income returns are again positive on the week. The rotation that was the theme of the review last week continues. The Nasdaq underperformed all other markets here, close to 1% underperformance versus the S&P 500. TSX doing a little bit better. So we're seeing this rotation from tech and growth to other sectors that were left aside. Still the biggest performer of the year is gold, 22%. S&P 500 not too far behind. So Bank of Canada now, there wasn't much new information here. So I'll just focus, on just the chart. You see 3 cuts already in. The target is somewhere around 3%. We think we'll be there by about mid-2025. The quote on the left is from the opening remarks of Mr. McClem. So again, if inflation continues to ease broadly in line with our forecast, it is reasonable to expect further cuts in our policy rate. They said the same thing in July, so that confirms that we're on this cutting path here. An interesting tidbit is that also in the opening remarks, they did say that they do expect inflation to perk up a little bit by the end of the year, mostly for statistical reasons, but still they're worried that inflation is cooling too quickly. So that's Bank of Canada's speech to say that even if there is volatility in inflation coming in the next months, our mind is pretty much set. This is how we would interpret it. So the message is pretty clear here. The jobs report now in Canada, nothing here to change the mind of the bank. The last 2 months had been negative prints, but now we return to a positive one, above 20,000 jobs added. So we're still not creating enough jobs in the country to accommodate all of this growth in the population, but still it's a positive. Nothing here to change the course from the bank. And the wage growth is slowing down a little bit, but still elevated. So there's more work to be done here by the bank. So very quick comments here. The main report this week on the macro front was the US jobs report. The last month was weak, and it came just 2 days after Mr. Powell pretty much said that we're not looking so much at inflation now, we're looking more at growth in the labor market. So I'm just paraphrasing here, but now and then the weak job report came in just after, created some volatility in the markets. Now we've had a downward revision to last month, so it was even worse than what was published, but there was a bit of a rebound this month. But it's a timid rebound, so again, there is not much information here that will make anyone change their mind if they think 25 or 50. We know there's going to be a cut. We still think it's 25. We're not changing our mind. The reason why we think it's going to be 25, well, we think that the bottom is not falling out. On the right, you see the jobless claims. They are not rising, so it's not like there's massive layoffs here. It's just that the firms are hiring less and less. Normalization of the labor market. Hours worked were a bit higher, so the average work week, there's more hours worked. Wage growth was a bit hotter on the month, so there's still some bargaining power on the side of employees. So it's a market that is slowly normalizing. It's not a market that is falling off a cliff. At least this is what we believe. And if you look at the chart on the next slide, a chart that we've used quite a bit during the pandemic, the labor market is much less tight than before. The blue line is the number of job openings, jobs that are open and not filled, and the gray line is the number of unemployed Americans. At some point, the gap was multiple millions. Now we're down to 500,000. Looking at the trend here, of course, this is just about set to reverse, but the norm prior to 2019 was that there was more unemployed and jobs open in the country. So again, this is a normalizing process. Of course, things could normalize a bit too quickly. At some point, you can fall into contraction mode. But for now, we don't think it's warranted to go with 50 basis points and hit the panic button. What the market is pricing, well, you have the chart here. Markets are giving pretty much 60% odds of a 50 basis point cut in mid-September. So we need to take this seriously. Maybe we're wrong. Maybe the market is right. We'll see in 2 weeks. But the focus on the CPI now next week, likely there won't be that much information there to change anyone's minds. So it's a very live meeting with some potential for market volatility for sure on September 18. So maybe just to close off with the road to the US presidential election, I want to cover it every week. This week, not much new information. Kamala Harris still leading in the polls on the left, but as I explained over the last few weeks, the Electoral College still favors Donald Trump. So it's, even though Kamala Harris is leading, she needs to lead by 4 or 5% in the polls to have a shot at beating Mr. Trump. Or at least she needs to win most of the swing states. So it's complicated. Chart on the right tells you that the most likely scenario, based on betting odds from Polymarkets, is a divided government. But see the red line that is climbing. This is a signal that bettors are seeing that it's going to be harder and harder for Mrs. Harris to beat Mr. Trump, and there's odds that the Senate should stay with the Republicans, but also there's odds that the Republicans could take the Congress, so we could have a sweep. So what's rising in the odds here is the odds of a sweep of the Republicans. It's still an alternative scenario, but the odds are rising. That could have, of course, some very important consequences in terms of economic reforms if we go into that scenario. So it's still an alternative one, but this is the one where you see the odds rising right now. We wrote a lot about the implications of all of that in our monthly on iagam.ca throughout the year. So we certainly encourage you to go take a look if you want to read more of our thoughts here. So what we'll be watching next week in Canada, building permits. Last month we had a negative print. Let's see where we go. And in the US, the CPI number, again, very important number given the uncertainty around what the Fed will do. And the University of Michigan Sentiment Index should tick up a little bit higher at 68.5 in September. So always a pleasure to serve you. If you enjoy the content, please share and also be back again next week.